welcome to this explainer. Okay, let's get right into it today. We are stepping into the mindset of a professional trading mentor to give you a definitive blueprint for one of the most widely used and honestly most misunderstood tools in trading, the MACD indicator. If you've ever felt like your entries are just consistently late, or if you're totally exhausted from getting chopped up in ranging markets, you are in exactly the right place. We're going to take you from the very basic anatomy of the indicator all the way through to executing 4 advanced, highly disciplined trading strategies. So get your notes ready. We are treating this explainer like an absolute masterclass in risk management and precise market execution.
All right, let's dive into our roadmap for today. First, we'll tackle the lagging entry problem, then break down the anatomy of the MACD. After that, we're spotting high probability signals before getting into the real meat, 2 powerful reversal strategies, followed by 2 trend-following strategies.
Section 1. The lagging entry problem. We've got to start with a massive hurdle that trips up both newcomers and seasoned pros alike. Relying on traditional indicators usually means missing the best part of the move.
Think about traditional moving average crossovers, right? Like the 12 and 26 EMA. They usually only happen after the price has already made a huge move. You're late to the party, and because you're late, you have to use a much wider stop loss just to stay safe. Higher risk, drastically reduced profit potential. It's frustrating. But contrast that with the MACD crossover. The MACD actually gives you a much earlier heads up that a reversal is happening. By catching that momentum shift before the price even physically crosses those traditional averages, you get a way better entry price, which means a tighter stop loss. This is exactly how disciplined risk management works. You capture the meat of the trend while keeping your risk absolutely minimal.
Moving right along to Section 2, Anatomy of the MACD. To really leverage this advantage, a pro trader absolutely has to understand how their tools work under the hood.
So, the MACD, it stands for Moving Average Convergence Divergence, and it's basically an engine built from 3 moving parts. First up is the MACD line itself. Honestly, this is simply the 12-period exponential moving average minus the 26-period EMA. When the fast 12 is above the slow 26, the MACD line sits above 0. Easy enough, right? Part 2 is the signal line. This is a 9-period EMA of the MACD line itself. Why does it exist? Specifically to act as a trigger, giving us those early crossover entry signals we just talked about. And finally, Part 3, we have the histogram. All this does is measure the actual physical distance between the MACD line and the signal line.
Now I want you to think of the histogram as your visual momentum meter. When the MACD line and the signal line are spreading further apart, the histogram expands. You get these dark growing bars. That tells us the trend momentum is solid, it's strong. But the absolute second those bars start shrinking and turning a lighter color, pay close attention. Shrinking histogram bars are literally your earliest visual clue that the momentum of a move is dying. For a disciplined trader, this is a prime screaming signal that a reversal or a sideways chop is coming, and it's probably time to exit your current trade to protect your capital.
Section 3. Spotting high probability signals. Because look, knowing the basics is great, but basic MACD crossovers can definitely generate false signals. We need a mental pre-trade checklist to filter out the noise.
And that brings us to a professional trader's absolute secret weapon, divergence. Divergence is a critical sign of a potential reversal. It happens when the actual price action on your chart and the MACD indicator are basically disagreeing with each other, moving in completely opposite directions. But listen, here's my strict mentor rule for you today. If the divergence isn't completely 100% obvious to the naked eye, do not trade it, period. We only want undeniable, clear discrepancies to keep us out of bad setups.
So what does this actually look like? Well, a bullish divergence happens in a downtrend. The price drops to a new lower low, but the MACD histogram, it makes a higher low. This is huge. It brilliantly illustrates that the sellers are utterly exhausted. The momentum of that latest drop was way weaker than the previous one. On the flip side, a bearish divergence happens in an uptrend. The price pushes up to a higher high, but the MACD makes a lower high. The buyers are totally gassed out, they're losing strength, and sellers are ready to take control. This divergence right here, that's your early warning radar.
Section 4. 2 powerful reversal strategies. Now that we have our high probability indicator down, let's look at our first pair of advanced strategies, custom built for catching these exhaustion reversals.
Strategy 1 marries divergence with good old support and resistance. Because remember, we never ever trade divergence in isolation. Step 1. Identify a major support or resistance level on a higher time frame, like your 4-hour chart. Step 2. As the price gets close to that level, zoom right into a lower time frame, say the 1-hour, and hunt for that obvious MACD divergence we just talked about. Step 3, and this is your strict entry trigger, so don't jump the gun, look at the MACD histogram. Find the lowest point between the two MACD peaks, mentally draw a line right there, and only enter the trade when the histogram actually breaks that specific line. That confirms the reversal is happening. And for our disciplined risk management, your stop loss must be tucked tightly just beyond that higher time frame support or resistance level.
Next up is strategy 2, which builds out our reversal toolkit perfectly. This one pairs divergence with Bollinger Bands. First, set your Bollinger Bands to a length of 200. Now, the whole underlying theory here is that price spends about 90% of its time inside these bands. So for step 2, you're waiting for a super strong trend to shove the price completely outside the bands, while at the exact same time, you spot that obvious MACD divergence. It's a massive, high-probability reversal trap. Step 3. Your exact mechanical entry happens on the very first candlestick that successfully closes back inside the Bollinger Bands. Place your strict stop loss just outside the extreme wick of the candle that pierced the band, which perfectly protects you against a fake out.
All right, section 5, 2 trend-following strategies. Reversals are incredibly profitable, but the old saying holds up: the trend is your friend. Let's shift gears and look at safely buying pullbacks in strong, established markets. Strategy 3 uses EMA bands and zero-line pullbacks. First, you're going to plot 3 200-period EMAs, one on the highs, one on the close, and one on the lows. This creates a really nice visual ribbon on your chart. Step 2. In a strong trend, just patiently wait for the price to pull back and test that ribbon. Step 3. Confirm that the MACD line has also pulled back to its zero line, right to the indicator's midpoint. Now, the crucial point is our entry in step 4. Listen closely. We do not use MACD crossovers here. They lag way too much during pullbacks. Instead, draw a short-term trend line right over the pullback itself and pull the trigger the second the price breaks that trend line in the direction of the main trend. Boom! Throw your stop loss safely on the opposite side of the 200 EMA ribbon.
Strategy 4 is all about swap zones and zero-line pullbacks. Step 1. Identify a breakout where an old ceiling of resistance has turned into a new floor of support, or vice versa. We call these dual property areas swap zones. Step 2. Wait for the price to pull back to this brand new zone. Step 3. Check your MACD. You want to make sure it's holding at or right near that zero line, which tells us the broader trend momentum is gearing up to resume. And finally, step 4, the sniper entry. Wait for a specific reversal candlestick pattern right at that swap zone. Think a doji or an evening star. When you combine market structure, MACD momentum, and candlestick price action, it's just a masterful setup. Complete the trade by placing your stop loss tightly just below the bottom edge of that swap zone.
To bring this whole thing together, here is your Strategy Master cheat sheet. As a disciplined trader, this is your ultimate pre-trade checklist to ensure all your indicators actually align before you even think about entering. Look, if the market is just chopping around or climaxing at the end of a crazy extreme trend, you're deploying strategies 1 and 2, hunting for those exhaustion divergences. But if the market is in a nice steady trend, shift into pullback mode. Use strategies 3 and 4 with those EMA ribbons or swap zones alongside the MACD zero line. Keep this guide handy. It's exactly how you match the right tactic to whatever environment the market throws at you.
And that leaves us with a pretty provocative question for your own trading journey. Which of these 4 strategies are you going to master first? Seriously, don't try to learn them all at once. Pick just one. Take it to your charts and safely backtest it using historical data before you ever risk a single dime of real capital. And remember, even the absolute best setups will face losing streaks. The mental habit you must develop is trusting your stop losses and completely avoiding revenge trading at all costs. Getting chopped up by lagging signals is a choice. Trading with disciplined precision is entirely within your grasp once you start reading momentum like a pro. Thank you so much for hanging out with me for this explainer, and happy charting.